Ladies and gentlemen, I'm your investor friend. We need to have a very serious conversation about what happened to your portfolio while you were sleeping last night. If you looked at your screen this morning, you witnessed a crime scene. You saw silver, which was trading near $83 just yesterday, suddenly plummet in a terrifying freefall into an abyss, bottoming out at $73.72. That represents a 14% drop in a matter of minutes. That's the kind of volatility that annihilates accounts, destroys confidence completely, and makes grown men panic and sell at the absolute bottom. But I'm here to tell you that what you just witnessed wasn't a market correction at all. It wasn't a change in fundamentals. It wasn't retail traders taking profits or the bubble finally bursting. What you witnessed was a mechanical execution, pure and simple. It was a financial assassination carried out in the darkness, under the cover of the thinnest liquidity of the entire year. Want to be prepared for silver's next explosive move? Subscribe now and hit the bell icon so you don't miss any critical analysis. Knowledge is power in these manipulated markets. Join our community of smart investors today and protect your wealth. And if you sold your silver this morning because you were scared and panicked, you didn't just lose money on a bad trade. You fell victim to a specific algorithmic event known as a value-at-risk shock, or a VAR shock. To understand why silver crashed 14% today, December 29th, 2025, you have to stop looking at the news headlines and start looking at the clock instead. The crash didn't happen at 9:30 in the morning when the New York Stock Exchange rang its opening bell. It didn't happen during the prestigious London fix. It happened at exactly 2 in the morning, Eastern Standard Time. Now ask yourself this critical question. Who is trading silver at 2 in the morning on a Monday during a holiday week? Is it the retail investor sitting at home in Ohio? No, he's sleeping peacefully. Is it the silver stacker in Germany? No, he's having lunch with his family. Is it the pension fund manager? No, he's in Aspen skiing and enjoying his holiday vacation. The market at 2 a.m. during what we call Ghost Week, that cursed week between Christmas and New Year's, is literally a financial ghost town. The order book is completely hollow and empty. The bid stack, which is that protective wall of buy orders that normally catches and supports a falling price, is as thin as tissue paper. There is absolutely nobody home. No traders monitoring screens, no fund managers watching positions, no liquidity waiting to absorb sales. And that is precisely why the crash happened when it did. This wasn't an accident or random market event. This was a perfectly timed attack, executed with surgical precision at the moment of maximum system vulnerability. At approximately 2 a.m., a massive institutional whale, and when I say massive, we're talking about an enormous hedge fund or a prime brokerage client with truly astronomical leverage, hit an impenetrable wall. They didn't simply lose a little money on an unfortunate trade, they violently breached their maintenance margin, crossed the point of absolute no return. In the institutional world of high finance, when you breach your maintenance margin, the rules are brutally clear and merciless. You don't receive a polite, courteous phone call from your broker kindly asking if you might consider depositing a bit more cash into your account. There's no friendly conversation, no negotiation, no grace period, no second chance to rectify the situation. You get liquidated, period. End of story. And you don't get liquidated by a compassionate human being with empathy who genuinely cares about getting you the best possible price or minimizing damage to your wealth. You get liquidated by a completely automated risk engine, a soulless digital entity. The risk engine is a cold, calculating, mechanical algorithm absolutely devoid of any human feeling or compassion whatsoever. It's programmed with one single, relentless, unbreakable instruction. Get me out of this position right now. Immediately, without any delay whatsoever. Without considering consequences or fair prices, to understand why silver fell 14% today, December 29th, 2025, you need to stop looking at the news headlines and start looking at the clock instead. The crash didn't happen at 9:30 in the morning when the New York Stock Exchange rang its opening bell. It didn't happen during the prestigious London fix. It happened at exactly 2 in the morning, Eastern Standard Time. Now ask yourself this critical question. Who is trading silver at 2 in the morning on a Monday during a holiday week? Is it the retail investor in Ohio? No, he's sleeping soundly in his bed. Is it the precious metals stacker in Germany? No, he's having lunch peacefully with his family. Is it the pension fund manager overseeing billions? No, he's in Aspen skiing and enjoying his end-of-year holiday vacation. The market at 2 a.m. during what we call Ghost Week, that cursed, infamous week between Christmas and New Year's, is literally a financial ghost town of epic proportions. The order book is completely hollow and empty. The bid stack, that protective wall of buy orders that normally catches and supports a falling price like a safety net, is as thin as tissue paper. There is absolutely nobody home, no traders awake monitoring their screens, no fund managers watching their positions, no liquidity waiting patiently to absorb sales. And that is exactly, precisely, the fundamental reason why the crash happened when it did and not at any other time. This wasn't an accident or random market fluctuation. This wasn't bad luck or unfortunate timing. This was a perfectly timed attack executed with surgical precision at the exact moment of maximum vulnerability in the system. At approximately 2 a.m. in the morning, a massive institutional whale, and when I say massive, we're talking about an enormous hedge fund or a prime brokerage client with truly astronomical, mind-boggling leverage, hit an impenetrable wall of mathematical reality. They didn't simply lose a little money on an unfortunate trade gone wrong, they violently breached their maintenance margin requirement, crossed the point of absolute no return. In the institutional world of high finance and professional trading, when you breach your maintenance margin, the rules are brutally clear, absolutely merciless, and completely unforgiving. You don't receive a polite, courteous phone call from your friendly broker kindly asking if you might possibly consider depositing a bit more cash into your account to fix the situation. There's no friendly conversation, no negotiation, no grace period, no second chance whatsoever to rectify the problem or raise additional capital. You get liquidated. Period. End of story. No exceptions. And you don't get liquidated by a compassionate human being with empathy and understanding who genuinely cares about getting you the best possible price or minimizing the damage to your wealth and reputation. You get liquidated by a completely automated risk engine, a soulless digital entity without conscience. The risk engine is a cold, calculating, mechanical, and absolutely ruthless algorithm devoid of any human feeling, emotion, or compassion whatsoever. It's programmed with one single, relentless, unbreakable instruction, hard-coded into its core. Get me out of this position right now, immediately, this very second, without any delay whatsoever, without considering consequences, market impact, or fair pricing. This algorithm has no moral consciousness, experiences no emotions, feels no remorse or guilt. It doesn't care at all if the current asset price is $83 or $73 or even $50. Those numbers are completely irrelevant to its core programming. It doesn't care about technical support levels that chartist analysts spend countless hours studying meticulously. It doesn't consider whether the RSI indicator is showing extreme oversold conditions. At approximately 2 a.m. in the morning, a massive institutional whale, we're talking about an enormous hedge fund or a prime brokerage client with truly astronomical, mind-boggling leverage, hit an insurmountable wall of mathematical reality. They didn't simply lose a little money on an unfortunate trade that went sideways. They violently breached their maintenance margin requirement, crossed the critical threshold from which there is absolutely no return possible. In the institutional world of high finance and professional trading, when you breach your maintenance margin, the rules are brutally clear, absolutely merciless, and completely unforgiving without any exceptions whatsoever. You don't receive a polite, courteous phone call from your friendly broker kindly asking if you might possibly consider depositing a bit more cash into your account to fix the problem. There are no friendly conversations, no negotiations, no grace period, no second chance whatsoever to rectify the situation or raise additional capital. You get liquidated, period, end of story. No exceptions under any circumstances. And you don't get liquidated by a compassionate, understanding human being with empathy who genuinely cares about getting you the best possible price or minimizing the catastrophic damage to your wealth and reputation. You get liquidated by a completely automated risk engine, a soulless digital entity without any human conscience whatsoever. The risk engine is a cold, calculating, mechanical, and absolutely ruthless algorithm entirely devoid of any human feeling, emotion, or compassion. It's programmed with one single, relentless, unbreakable instruction, permanently hard-coded into its core logic. Get me out of this position right now, immediately, this very second, without any delay whatsoever. Without considering consequences, market impact, collateral damage, or fair pricing principles, this algorithm has no moral consciousness at all, experiences absolutely no emotions, feels no remorse or guilt about its actions. It doesn't care at all if the current asset price is $83 or $73 or even $50 or zero. Those numbers are completely irrelevant and meaningless to its core programming directives. It doesn't care about technical support levels that professional chartist analysts spend countless hours studying and analyzing meticulously. It doesn't consider whether the RSI momentum indicator is showing extreme oversold conditions that would normally attract buyers. It doesn't analyze fundamental news about the market or evaluate global macroeconomic trends. It doesn't consult analyst reports or expert predictions about future price movements. Its only job, its only directive permanently programmed into its source code, is to sell absolutely every single unit of the position as fast as digitally possible, until the account becomes mathematically solvent again according to the parameters established by regulators and clearinghouses. So precisely at 2 a.m. on December 29th, when this merciless machine suddenly woke up, automatically activated itself and began firing massive, aggressive market sell orders directly into the silver futures market, something truly catastrophic and historic was about to unfold in real time before our eyes. In a normal, healthy market functioning during regular business hours with full liquidity and multiple active participants monitoring their screens carefully, those gigantic sell orders would have been absorbed without major problems. Institutional buyers, opportunistic funds hunting for bargains, algorithmic traders programmed to catch falling knives would have immediately stepped in to purchase that merchandise at slightly reduced prices. The price perhaps would have experienced a moderate decline of merely 50 cents, maybe $1 maximum in the worst-case scenario, before finding equilibrium and stabilizing again with fresh buyers entering the market confidently. But this wasn't a normal market at all. This was the financial abyss of the year. In the graveyard shift, in that completely abandoned and desolate overnight time frame of the infamous Ghost Week, that cursed week between Christmas and New Year's, when absolutely all major institutional players are on vacation, there were no buyers waiting in the shadows. The order book was empty. The void was total and absolutely terrifying. Part 4. The Liquidity Cascade. The algorithmic machine sold the first 1,000 futures contracts and the price immediately dropped a full dollar. The algorithm then desperately scanned the order book searching for more buyers willing to absorb the next wave of sales. It found none. Absolutely zero. The void was total and terrifying. So without alternatives or mercy, it lowered the price another dollar to find hidden liquidity at lower levels, desperately hunting for buyers willing to enter the market with cheaper bids. It continued selling relentlessly and the price kept falling without breaks. $80, then $78, then $76. The algorithm was hunting for phantom liquidity that simply didn't exist at any level. This is exactly what professionals call a catastrophic liquidity cascade. It's like a massive grand piano falling from a 10th floor window. Once it begins its descent, it doesn't stop, doesn't break, doesn't pause until it finally crashes violently into the pavement below. The pavement, in this specific case, the final impact point, was exactly 73.72. That was the precise level where the ruthless algorithm finally found enough brave or foolish buyers to completely clear the order book. So when you look at that chart and see that massive, gigantic, terrifying red candle on your screen, don't think for a second that silver's bull trend is over forever. Don't interpret this as a signal of fundamental weakness. Think instead that someone just got brutally murdered in the financial building's basement. This was an absolutely forced liquidation, not voluntary. It was a margin call of truly epic historic proportions. And the most critical detail that the mainstream financial press is completely and deliberately ignoring in their superficial reports is that this massive selling was completely price agnostic. The institutional seller didn't want to sell at $73. They were brutally forced to sell at $73 by regulatory and mathematical requirements. That's an absolutely enormous and fundamental difference. If investors were voluntarily selling because they genuinely thought silver was worthless, that would be genuinely bearish. But if an automated machine is mechanically selling because a leveraged gambler spectacularly went bust, that's incredibly bullish for everyone else. It means the weak hand has been eliminated. The leverage has been purged from the system. The market is now cleaner, lighter, and ready to move aggressively higher. But the damage didn't stop with just one whale. The initial dump triggered a secondary devastating explosion that acted like pure gasoline poured on an out-of-control fire. Because when the price began its free fall through $78 and $76, it woke up another dangerous sleeping beast living in the servers and computers of market makers and professional options dealers. We need to talk urgently about gamma. Specifically, we need to talk about the gamma flip that transformed an already bad situation into a total and absolute disaster. Because when that institutional whale began violently vomiting its massive position at 2 a.m., the banks on the other side of the trade, the professional market makers, suddenly found themselves trapped in a mathematical nightmare of monumental proportions. They were short put options and long gamma. And when the price began to collapse vertically, their positive gamma dramatically flipped and converted into negative gamma. I know this sounds extremely technical and complicated, but you absolutely need to understand this concept to comprehend why the crash was so violent, so fast, and so devastating. Negative gamma means that for every dollar the price falls in the market-making bank is mathematically forced, obligated by their risk models, to sell more silver to hedge and balance their book of positions. This creates what we call a doom loop, a death spiral, a vicious cycle from which escape is impossible once initiated. The price initially falls. The bank then sells aggressively to hedge and protect their exposure. That additional selling causes the price to fall even more. The bank, seeing the price drop further, is obligated to sell even more metal, and the cycle repeats endlessly, accelerating exponentially. This is precisely why the drop went from being a simple, healthy, technical market correction to becoming an absolute apocalyptic crash in a matter of seconds, not minutes or hours. The dealers, the institutional market makers, became forced sellers right alongside the whale being liquidated. They were chasing the price downward, sinking deeper and deeper into the financial abyss, literally cannibalizing and destroying their own market because their sophisticated risk management models ordered them to do so without mercy. It was a completely automated robotic feedback loop of pure destruction. And absolutely all of this happened while you slept peacefully in your bed, completely oblivious to the financial chaos unleashing. So when you look at that brutal 14% loss on your screen this morning, when you see that bleeding red number in your portfolio, you must realize and understand that it's completely artificial. It was artificially created by a temporary vacuum of buyers and a simultaneous excess of forced robotic sellers executing orders mechanically. It has absolutely nothing to do with silver's real fundamental value as an industrial and monetary commodity. It has nothing to do with the irrefutable fact that solar panels need massive quantities of silver for their manufacturing. Nothing to do with the documented fact that silver mines are virtually empty and production is falling. This was simply a catastrophic plumbing failure of the financial system. And exactly like when a serious plumbing failure occurs in your house, when the main pipe violently explodes, someone absolutely has to enter urgently and repair it immediately before the entire structure floods completely and the damage becomes totally irreparable and permanent. When you see that 14% loss, understand it's completely artificial, created by a vacuum of buyers and excess of forced robotic sellers. Nothing to do with silver's fundamental value. Nothing to do with solar panels needing silver. Nothing to do with empty mines. This was a financial system plumbing failure. When the price hit $73.72, the system began shaking violently. The clearinghouses realized the exploded whale couldn't pay their bill. If the whale defaults, the clearinghouse is liable. And if the clearinghouse fails, the entire financial system collapses. Here the story shifts from flash crash to systemic rescue. Right at the bottom, when silver looked like it would hit zero, massive liquidity suddenly appeared from nowhere. A $34 billion emergency injection. No press release, no Powell speech. But if you examine repo market data and overnight swap lines between central banks, you see the fingerprint clearly. Someone intervened decisively. Someone with unlimited resources plugged the catastrophic hole. This brings us to the number nobody at CNBC wants to discuss today, $34 billion. You saw the 14% crash, but didn't see the massive sandbag thrown into the banking system overnight to prevent the dam from breaking completely and causing apocalyptic flooding. This brings us to the number that absolutely nobody at CNBC, Bloomberg, or any other mainstream financial network wants to talk about today. The magic number, the forbidden number, is exactly $34 billion. You saw the crash with your own eyes this morning. You witnessed the brutal and ruthless elimination of 14% of value in minutes. But what you didn't see, what remained completely hidden and concealed in the dark underground plumbing of the international overnight banking system, was the absolutely massive sandbag that was strategically thrown to prevent the financial dam from breaking completely. But here's the greatest irony, the absolutely painful, twisted, and almost comical irony of this entire extraordinary situation. While the Western financial system was frantically and desperately printing $34 billion from thin air to patch a gigantic hole caused by a catastrophic explosion of synthetic paper derivatives with no real physical backing, the tangible physical world was watching from afar and laughing hysterically at the situation. Because while the artificial paper price was collapsing vertically in Western markets controlled by algorithms, the real thing, the tangible physical metal you can touch with your hands, was doing something completely different, something that totally contradicted the official narrative the media wanted to sell. This brings us directly to Shanghai's brutal reality check, the moment of absolute truth. If you want to know the genuine truth about a financial crime, you don't ask the criminal who committed it. You ask the impartial witness who saw everything from outside, and the silent but eloquent witness of this historic crash is precisely the Shanghai Futures Exchange in China. While New York was busy destroying paper wealth, burning trillions in valuation, China was busy pricing silver as if absolutely nothing had happened in the Western world. I'm looking directly at the official Shanghai closing data right now. The front-month silver contract closed at exactly 20,073 Chinese yuan per kilogram of pure silver. Let's do the critical math because this is literally the most important calculation of your financial life right now. Take 20,073 yuan and divide it by the current exchange rate of approximately 7.04 yuan per US dollar. Then divide that result by 32.15 troy ounces in 1 standard metric kilogram. The final result is astonishing, $89.18 per ounce. Can you see the massive disconnect? In the West, the official price is $75 because a giant hedge fund exploded and the Fed had to emergency rescue the repo market. In the East, the real market price is $89 because they desperately need physical silver for solar panels and hypersonic missiles. The spread is now an incredible $14 per ounce. This isn't temporary market inefficiency. This is a completely broken, fractured market. The $14 spread between these two prices represents a broken market. A $14 spread on a globally traded commodity is absolute economic insanity. It means that for every ounce of silver you own, the Chinese market believes it's worth 20% more than the American market thinks it's worth. Why isn't arbitrage closing this gap? Why aren't traders buying at $75 and selling at $89 to capture this enormous profit? Because they can't. The January 1st export licenses have built an impenetrable wall around China. The metal in Shanghai is trapped inside. The metal in New York is scared and running. The two prices have completely divorced from each other. This $14 premium is definitive proof that the crash was fake. If there was a real glut of silver, if there was genuine oversupply flooding the market, the price would be falling in Shanghai too. But it isn't falling at all. It's holding rock solid near $90. The drop in New York is purely synthetic, a paper event manufactured by algorithms. The absolute undeniable proof is in the COMEX vaults from Friday. While the price was beginning its descent, while the Ghost Week trap was being set, the smart money was backing up trucks to the loading dock. Exactly 133 ounces of physical silver were withdrawn from COMEX vaults on Friday. Gone. Removed from the system completely. Think about the timing of that massive withdrawal. 600,000 ounces left the vault before the crash hit. Whoever took that metal didn't care about charts or RSI indicators. They saw the price, they saw the coming shortage, and they took the physical metal into their own possession immediately. They drained the vault systematically. This is the behavior of a buyer who knows with absolute certainty that the paper price is fake. They're using the paper suppression to drain physical supply at a massive discount. It's the ultimate bank run playing out in slow motion. They're trading their paper fiat currency, which the Fed just printed $34 billion more of, for the hardest asset on the planet. This withdrawal explains why the Shanghai premium is real and growing. The metal is physically moving from the weak hands of the West to the strong hands of the East. The West is becoming an empty shell, a showroom with no inventory. The price tag says $75, but when you go to the shelf to actually buy the product, the shelf is completely empty. That 600,000-ounce withdrawal is the sound of the shelves being systematically cleared by those who understand what's really happening. And this brings us to the most dangerous, most manipulative lie being told right now on every corporate financial news network. Turn on your television and what do you hear repeatedly? Widespread retail panic. Mom-and-pop investors are fleeing terrified from the silver market. The speculative silver bubble has finally burst definitively. They're blaming you directly. They're trying to manipulate you into believing that this massive 14% drop was caused by thousands, perhaps millions of small individual investors mysteriously waking up at 2 a.m. on a Monday during a holiday week and collectively deciding, all at the same time, to sell their precious physical silver coins. It's absolutely insulting to intelligence. It's a blatant fabrication, a completely invented lie. And I have hard, verifiable data that irrefutably proves it's total nonsense. We have complete access to detailed flow data from the largest ETFs. We have precise transaction volume data from all major precious metals, coin and bar dealers. Do you know exactly what real retail investors did while the price was violently collapsing toward $73? They bought aggressively. Net capital inflows into major silver ETFs like SLV and PSLV literally skyrocketed exponentially this morning. Retail investors didn't sell a single ounce. On the contrary, they bought the dip massively. Transaction volume at major online bullion dealers, AppMax, JM Bullion, SD Bullion, is currently 3 times higher than a typical normal Monday. And 90% of that gigantic volume is concentrated on the buy side, not the sell side. The smart small investor saw the price drop and simply said, "Thank you for the generous discount, I'm buying more." So if retail didn't sell anything, who exactly sold? Who brutally dumped 5,000 futures contracts in a single second at 2:15 a.m.? It was the institutional whale. It was the absolutely forced liquidation of the over-leveraged institutional player we discussed in Part 1. The massive selling came from an entity in extreme financial distress that had absolutely no choice or alternative. It came from a cold robot mechanically executing an inevitable bankruptcy order. So why exactly are corporate media lying so blatantly? Why are they pushing the false retail panic narrative with such insistence and aggression? Because they desperately need a convenient scapegoat. They can't publicly admit that a giant financial institution exploded spectacularly. They can't admit the clearinghouse nearly collapsed and needed a $34 billion emergency injection. If they told the uncomfortable truth that the system is extremely fragile and broke down catastrophically from one bad bet, it would cause genuine massive panic. It would cause a real bank run. So instead they blame all the wild volatility on supposedly unsophisticated, ignorant retail traders. They're psychologically manipulating you. They want you to believe you're the weak hand, so you'll doubt yourself and actually become the weak hand that panic sells. It's a deliberate, calculated psychological operation designed to shake you out. They're trying to violently shake you out of your valuable position because they desperately need your physical silver. Remember the 600,000 ounces that mysteriously left the COMEX vault. Remember the massive $14 premium in Shanghai. The truly smart money, the strong institutional hands, are absolutely desperate to get their hands on tangible physical metal before January 2nd, when everything changes dramatically. And the only possible way they can get sufficient volume quickly is if they manage to convince you to sell yours out of irrational fear. They're desperately fishing for your shares. They violently destroyed the price to scare and terrorize you, and now they're using all mass media to psychologically shame you and make you doubt yourself. But cold hard data never lies. The retail investor is the truly smart money today, not the institutions. You're the one buying the asset that China is generously paying $89 per ounce for, while supposedly sophisticated professionals are being brutally liquidated and destroyed. You're the one firmly holding the lifeboat, while the institutional Titanic hits the deadly iceberg. And this brings us finally to the crucial final piece of the complete puzzle. If the forced selling has definitively ended, if the institutional whale is completely dead, and the retail investor is holding strong without panic selling, what exactly happens when the market officially opens on Thursday, January 2nd? We now have a market structure that's completely clean and purified. All the dangerous, toxic leverage is gone forever. The mechanical forced sellers are completely out of the game. The only people remaining actively participating in the market now are true long-term believers and industrial physical buyers with real need. And precisely on January 2nd, all the giant institutional desks return massively from their Christmas vacations with a specific corporate mandate to allocate literally billions of fresh dollars into strategic commodities as part of their mandatory quarterly rebalancing. This perfectly sets the stage for what we call the January 2nd gap, a well-documented technical phenomenon. We're not looking at a slow, gradual, timid recovery that takes weeks to develop. We're looking directly at a violent slingshot effect. The spring has been compressed to its absolute maximum tension point. The crash is definitively over. The elaborate trap failed spectacularly. The manipulators lost. Now comes the explosive bullish chase. Now comes the physical market's revenge against paper. Physical metal always wins eventually. Patience will be generously rewarded. Those who held through the artificial storm will see the sunshine. Silver will fly toward $100 and beyond. The real game is just beginning now. The weak hands are gone, the strong hands remain, and the squeeze is coming. Want to be prepared for silver's next explosive move? Subscribe now and hit the bell icon so you don't miss any critical analysis. Knowledge is power in these manipulated markets. Join our community of smart investors today and protect your wealth.